The time has come for the Cobra to rise up and reveal himself.
Tool number one is the required reserve ratio. And the goal of tool number one goes back to one of the reasons why the Federal Reserve was created. We already saw reason number one, to create currency stability, stability within our own money supply. Goal number two is to create stability in the banking system. One of the big problems with banks, let's take a look, when we deposit money into the bank can do two things with our money. It can either break the money into excess reserves, and from those excess reserves, the banks could do two things with excess reserves. Money that banks could have on hand, or why banks want us to deposit money in the first place is banks will lend the money. And when banks lend money, that's how they create profit and generate interest. But the problem with that, what led to all of the bank runs and bank panics, and ultimately caused so many different recessions and depressions throughout American history, was that banks didn't have any regulation over the money that they lent. And if they lent too much money and then people ran to the bank, well, they didn't have enough money on hand to cover people's savings deposits. And sometimes the bank collapsed. And on December 11, 1930, what Milton Friedman calls the real start of the Great Depression was when the Bank of America, the Bank of the United States, which was the largest bank it was not actually the Federal Reserve, but it was the largest bank in the United States. And when the Bank of America fails, people think that the Federal Reserve failed, but it was just a fancy name for the bank. And people got too confused, and then it started this massive bank run. And unfortunately and bizarrely, the Federal Reserve doesn't do what it's supposed to during the Great Depression. It just shows you that anyone at any position can panic. And the Federal Reserve, while capitalism gets a lot of blame for the Great Depression, the Federal Reserve equally should get a lot of blame because it doesn't do exactly what it was created for in 1930 when it was created in 1913. So, the little economic tangent. But before the Federal Reserve was created, it had the same exact issue. And people deposit money in the bank, that money becomes excess reserves, banks could keep it on hand or lend it. And there were no member banks there was no Federal Reserve before 1913, there were no member banks, it was the free banking era. And you had all of these bank runs because when there was a panic, people ran to the bank, and the bank had lent all the money out, and then the bank ran out of people's money, and people lost their entire savings accounts. Unless loans were called in from other banks, from all of the banks lending to each other. And if the banks invested that money poorly as well, which unfortunately some banks did shady things like that, and people's savings was gone. So when the Federal Reserve was created, one of its powers was the required reserve ratio, which said you can't be careless with people's money. That if people put their money in the bank needs to be trusted. And you know what? You have to keep some money in the bank as well. You can't just lend all of your money out. And so the Federal Reserve, the required reserve ratio, tells banks that when a person deposits their money, and this is only for deposits, very importantly, the AP test is going to try to trick you with this too, the required reserve ratio is only for deposits. So when a person goes to the bank has to do two things with that money. It can now put part of that money must go to required reserves, and that's what the required reserve ratio is. It is a percentage of the amount the bank must keep on, it must hold. It cannot lend this money. And even though in the Great Depression there was a required reserve ratio, the Federal Reserve fails in other aspects as well, which we'll see in the next tool. So even though the Federal Reserve was there, and even though the Federal Reserve does perform admirably during most other economic crises. The biggest crisis that it had, the first real test, the second real test that it has, it fails. But nonetheless, tool number one, required reserve ratio. The goal is to create stability in the banking system, and that specifically that people should be secure in the knowledge that their money is safe in banks. And that's why the required reserve ratio has not been changed since the 1980s, going on 30 years, when it was lowered from 20% to 10%. So that means that when we deposit our money in a bank, the bank could either keep 90% of it, has 90% of the money to either keep cash on hand or lend, and then 10% must be put aside in case of emergencies. And although the Federal Reserve has not changed it in going on 30 years, if the Federal Reserve increases the required reserve ratio, that means banks must hold more money, which will decrease the money supply. That means there will be less M1 and M2 in circulation, less liquidity, less availability for money. If banks have less availability in money, if banks are forced to hold on to more money, then they will raise the nominal interest rate as a signal that they cannot loan out as much money, and since they cannot loan out as much money, they will raise the interest rate to make more with less. As banks raise as the general interest rate raises, this will raise the federal funds rate, which will be the rates that banks charge each other for interest, and it will also raise the real interest rate. So increasing the required reserve ratio will decrease the money supply, raising interest rates across the board, and would be contractionary. This would be to reduce the amount of ultimately borrowing in a country and investment spending and decreasing aggregate demand. Inversely, decreasing the required reserve ratio, which means banks that means more required reserves can now become excess reserves. So banks have to hold less money. This would increase the money supply. In order for banks to send a signal to everybody that, hey, we have more money to loan, and come borrow from the bank, they would lower the nominal interest rate. Remember, the nominal interest rate is a signal to everybody saying, hey, rates are lower, come borrow from us. And as the nominal interest rate is lowered, this would decrease the federal funds rate, the rate banks lend to each other, and also decrease the real interest rate. And now this would increase borrowing, it would increase specifically NAD investment spending, and would increase aggregate demand. However, like I said, it is the least used of the three tools because the Federal Reserve does not want to keep changing how much banks are forced to keep or not. That will make banks more reticent to loan money, more reserved to loan money, and therefore the Federal Reserve does this the least to add to the stability. However, if it did change the required reserve ratio, and if the test asks you about the required reserve ratio, this is what would happen. Let's take a look now at tool number 2, the discount rate.